We're celebrating over 2 million Canadians choosing Fidelity, and you could win one of these branded Fidelity hoodies. Just head to fidelity.ca/hoodie-contest for your chance to win. Performance is more than a number. It's confidence in your strategy and progress toward your goals. Choose performance, choose Fidelity. All right, back to the show.
Hello and welcome to FidelityConnects. I'm Pamela Ritchie. We're taking a look. We'll have to get the prompter rolling here. Today we are very lucky to be speaking with someone who can comment on opening bell equities, oil prices jumping 3% over the course of a crazy time for oil prices, with the Iran war nearing the 3-month mark. The surge that we've been seeing through markets is raising some fresh questions about inflation, certainly, central banks, and where investors might want to turn next. Our guest says that when it comes to Canada, investors still have time to get in early, with much of the long-term upside not yet priced in. So joining us here today to take a look at how the global asset allocation team is navigating the latest market dynamics, including the latest insights into Fidelity Managed Portfolios, is portfolio manager right at the top here, David Wolf. Welcome, David. Great to see you again.
You too.
Thanks for being here. Delighted to have you here. Let's begin with something that you've actually been talking, we'll invite questions in, by the way, everyone send your questions in for David Wolf, for quite a long time. This is a multipolar world. It's a world that is more fractured. It came to light in COVID, and I remember you said sort of the beginning of a deglobalized world, because it had to be at that point. Where are we with this now?
Sure. So let me start off with a couple of elements of that, and then we can unpack it, because there's a lot
there.
To it. Yeah. So the first thing I'd say is we think that this is a world that's more subject to inflation, inflationary bursts, inflationary shocks, and that has a myriad of implications for how we want to invest and how we want to asset allocate within the funds that I'm responsible for.
So long list of them there, by the way.
And we'll get into that. But first, maybe just give the background, right?
Yep.
So Iran is kind of the thing, right, that people are now worried about with respect to impact in inflation, and we've seen that through oil prices and some other commodities. In our view, Iran and the war there is really just the most recent manifestation of some deeper things that have been happening in the world for a long time, predating Trump, even predating COVID. So I think there are a couple of things to mention in that context. One, as you said, in a sort of breaking down world, a more multipolar world, that had been happening even before the pandemic.
Okay.
And you had seen, for example, exports as a share of GDP, global trade start coming down after coming up for 40 years. Mm-hmm. Then in COVID, you had all the supply chain shocks. And people realized that, far-flung supply chains are very efficient, but they're fragile. Mm-hmm. And when they get messed up, it actually is quite costly.
Right.
And so people doing more reshoring, shortening supply chains, which is more reliable, but more expensive, right? And then you come to more recently with things like Iran and the US policy kind of breaking up the world, that just adds to more cost, less efficiency, et cetera. And the Iran war is kind of a manifestation of that, in the sense that if you have what we call these supply squeezes all over the place, you're going to get an environment where inflation is more likely to break out. The second thing, if I may, a little bit, so that's the kind of deglobalization piece.
So oil is a piece of that now, whereas actually in COVID, there are lots of other supply chains that were messed up, but not so much energy in the way it is now.
Yeah, and so oil, the biggest part of oil is that Iran shock and the deglobalization that's behind it. The other piece, which actually fits in, but a lot more indirectly, is debt, right? So government debt has been rising for a long time, again, predating the pandemic. Then during the pandemic, borrowing ramped up enormously, Canada, the US, everywhere else, to deal with the pandemic's effects. And then it has ramped up substantially more recently, particularly in the US, with deficits, 5, 6, 7% of GDP on top of just a mountain of debt that already existed. When you have high government debt and rising government debt, mm-hmm. you have an increasing temptation among governments to inflate it away, because that's
how else are you going to do it? How else grow out of it? Yeah.
Growing out of it rarely works. Defaulting, you don't have to do if you issue your own currency. So inflation is kind of the time-tested way that governments get out of debt, right? Or get out of the real burden of their debt because they pay back dollars, for example, that are worth a lot less than the ones that they borrowed in the first place. And so in an environment where countries are tempted to inflate, you're going to get policies that are going to tend to lead to things that generate inflation. And so you have both things going on. You have the breaking up world, and Iran is a manifestation of that. And you have high and rising government debt, which tends to foster inflationary type policies. You put the two together, you have a world that inflation is likely to break out in, which it didn't for 30 years and then did in 2022, and now we have it again.
Yeah. Well,
sorry, that was long.
No, it's great. Let's dig into all aspects of that. So multipolar supply chains, we've been sort of aware of this for now. One of the pieces of that seems to get discussed a lot is the energy dependency story and energy independence, which arguably leads you to a discussion of Canada. There's also other roads to Canada in this discussion as well, but that's one of them. What we have to offer to the world, and whether we can offer that to the world more, essentially, which seems to be what we're sitting at. I don't know if it's a precipice we're sitting at, but we're sitting at something that seems to be the beginning of that taking hold in our economy and therefore your investments. Take us through how you get to this.
Sure. So again, a couple of things to unpack there. The first I would say is we don't know how the Iran war is going to work out, and we don't know what oil prices are going to do, over the next week, month, year, what have you. Nobody does. But no one in the world is going to look at what's happened and say, gee, I'm less worried about energy security and reliability of supply. So this is a world where those who have that reliable energy supply are going to increasingly be rewarded. And Canada is one of the relatively few countries that has a lot of energy and can be counted on in terms of producing and selling that energy to others. Now, we don't really have the capacity to do that at this stage, or at least to ramp it up. And that's why I think it's really important. A lot of what we're seeing, not only in the market, but from the government, that basically has been quite clear, at least in my eyes, to say, we get that unsticking energy investment in Canada is maybe the most important thing we can do for the broad economy over the long term. So we're going to try to do the things that foster that. We're going to try to give support to private investment. We're going to put in public investment. We're going to try to give predictability in terms of climate costs around that. It's not going to work tomorrow. It's not going to work next year, but it's the kind of thing that can pay real dividends down the line. And it's an environment where it's really sort of mistrusted or doubted by the market, because for many years, nothing happened. So there's a real skepticism in terms of, can you actually do this? And maybe we can and maybe we can't. But the upside is there and it's not priced, which is one of the reasons why, as you know very well, we were underweight Canada for 13 years and we're not underweight Canada anymore.
I mean, when I met you originally, I think you had a really low target on the Canadian dollar, and that low target stayed for lots of different reasons. The Canadian economy was dependent on housing, essentially, for growth for many, many years. That is over now completely? Or where would you take us in there? That's over.
Yeah, I mean, the housing market, so our view has been, and you and I have talked about this.
And we haven't gone into recession over it.
Yeah, so you and I have talked about this on this program for years and years, which is the Canadian economy was basically on a sort of road to nowhere, where all that was driving growth was basically borrowing a bunch of money, building houses and selling them to each other, which is ultimately kind of how you eat your own economy, because that doesn't do anything for your productive capacity in the long term, and it just adds to debt that you're then going to have to pay off. So now we're seeing the other side of that, with the housing market very weak in a lot of parts of the country. And so what you need to do is have something in the economy replace that growth. And right now it's not that much, which is why the overall economy is quite stagnant. And again, it's why the imperative exists, particularly at the government level, to actually drive higher capital investment to be able to sustain the economy short term, but also provide for that higher productive capacity long term that's going to allow us not to get on the road to nowhere again.
Picking up on your second point, because you spoke about debt at the beginning as well, much has been made about the fact that Germany suddenly took away their policy and was happy to issue enough debt to get their economy going in lots of different ways. This is a defense story. Canada, by all those that have a very optimistic view, say that we don't need to worry about debt or debt situation because it's okay. You agree with that? You're not worried about Canada's debt situation. You can afford to spend on building up the economy, essentially.
Well, so I'm always worried about everything.
I know.
That's kind of my job. But look, Germany has fiscal room and it's taking it because it needs to take it.
Yeah.
Canada has fiscal room and is taking it because it needs to take it. And the reason is different. It's not defense within Europe, which we get, but it's this need to invest in the economy to provide for longer term growth that we haven't had for a long time. I get asked a lot, and I think implicit in your question is, okay, well, you now have the federal deficit at its highest level in some time. Isn't that a concern for you, particularly a concern for you as a holder of billions of dollars of Canadian bonds, which we do? And so my response to that is, it doesn't really bother me, which may surprise some folks. But the reason it doesn't bother me is what I care about as a bond investor is getting paid back. And getting paid back not tomorrow, but the longer term, what I would call fiscal capacity of a country or a company or whatever we're buying the paper of. And in Canada, debt levels, at least government, consumer is another thing, but government debt levels are not that high, certainly compared to other countries. Okay. But also it really depends what you're spending the deficit money on. So if you're running big deficits and just giving the money to people, that doesn't do anything
for short-term political gains.
And that reduces fiscal capacity over time because you end up having to pay that back, right? If you're borrowing a lot of money and using it to invest in the productive capacity of the economy, which is what the focus at the federal level has been, in recent times.
The last year or so.
The last year or so. What that means is if you do it right, you're expanding the productive capacity of the economy, you're boosting longer term growth, and that increases fiscal capacity over a long period of time because you have a bigger economy and a wider tax base to support your debt. So long as debt is not that high and deficits are not outrageous, if it's being spent on things that expand growth over time, as a bondholder, I'm perfectly fine with it.
Okay, so let's ask one more question in there. The idea that there are inflationary forces in the world, some of which you just outlined, does that lead the Bank of Canada specifically, because we're talking about Canada and its build out, to have to, what's your call there on it having to raise rates to fight inflation, which will impact how the government pays back its debt?
Yeah, so the bank hasn't done anything for a while. I don't think is going to do anything anytime soon. Recent developments will have made the bank a bit more hawkish. And the reason is specifically higher energy prices obviously push inflation up, but they they push headline inflation up because of the oil prices. They push overall inflation up because higher energy prices are a net increase to demand in Canada. Right. And it doesn't feel like that when you and I go and fill up our cars, because that's obviously a drag on the consumer. But in aggregate, because oil is really important to the Canadian economy, particularly in Alberta, it ends up being a positive. So the bank looks at higher energy prices and says, yes, it matters where they come from and how they impact, but net, that's inflationary. Yeah. At the same time, the recent inflation data we got earlier this week were not particularly scary. They were a little bit they were a little bit lower than market expectations, and the bank still has underlying concerns, as they should, about the weakness of the domestic economy. So I think they'll be content to do nothing indefinitely. And that won't be forever, but...
We'll come back to Canada, because I actually think you'll probably get a couple questions about this as well. But just looking further afield to the rest of the world, how you look to allocate around the world. You discussed the US and the dollar and ultimately sort of the inflation story there. What's that led you to do, and then maybe to help you look elsewhere? But let's begin with sort of the US, less exposure, essentially.
Yeah. So I'll say once again, maybe for the third time today, there's a lot to unpack there. So we talked about the bank, we talked about the Canadian situation. In the US, you have the economy doing much better. You have inflation going up and going up faster than in Canada. And so you would think that would be an environment where the Fed would be more likely to raise interest rates. I don't think they're going to be raising interest rates anytime soon. And the specific reason for that is you have a new Fed chair, Kevin Warsh, and he, has been quite public with having a somewhat different view of the inflationary process. So he's talked about AI being this great deflationary force. He's talked about inflation really being driven by QE and increases in the money supply. And so he's less likely to react to higher inflation driven by higher energy prices, even in a fairly robust economic environment. Now, other people on the FOMC will disagree with him. And one of the really interesting things to watch is how that all comes together with Jay Powell still sitting there now, not as chairman, but still as a member of the board, and Kevin on the other side and all of the people around and where they come out.
Just how they duke it out to see whether interest rates either hold or go lower, like how they ultimately do that. But I guess
let me just
carry on,
follow on in there. So that's a thing. There is also a thing going on that's related, which is the underlying sensibility and reliability of US policy. So if inflation is more of a risk, you're supposed to raise rates. And if you don't, you risk letting that inflation run. And maybe to our earlier debt conversation, that can be good in terms of getting out from under a huge burden of debt, but it's really bad if you are a buyer of that debt. And so another way to put it is, I think the policies of the United States are increasingly creditor unfriendly. And if they're not being friendly to creditors, and that's pushing down the interest rates that they want to pay on the debt, that's pushing up inflation, so you get really negative real interest rates, it's pushing down the US dollar. If they're not being friendly to creditors, we don't want to be creditors of the government of the United States. So in the funds that I'm responsible for, we have sold out of all of our direct holdings of US Treasury bonds. We did that last year as this was kind of building, and
that's the lead. But anyway,
we're happy that we did. With 30 years rising over 5% and the US dollar still under some pressure, we're happy that we did.
Where do you put that money that you've sold out? Where do you reallocate around the world? Specifically, Canada is obviously a place, but where else?
Right. So we have bought quite a bit of Canadian bonds, and we just talked about that in the fiscal situation. We've reallocated to other fixed income markets around the world that we think have more sustainable fiscal situations and higher real interest rates on offer. And that's in Europe, that's in emerging markets, and even places like Japan, where rates on JGBs are not insulting the way they were for 20 years. We've reallocated back to the inflation conversation to commodities. So we've been holders of gold for quite some time as a diversifier, and that's been helpful for performance over the last couple of years. We also have established for use in our multi-asset funds a new commodity futures capability that lets us get an exposure to a broad array of commodities, not just precious metals or oil or industrials or what have you. We've allocated some to that capability as well.
So beyond just, for instance, Canadian producers or producers around the world of various commodities, the actual commodities themselves, the futures market for them.
That's right, because I mean, one of the things you worry about, and my job is ultimately a risk control and portfolio construction job. So we have all the equity managers choosing the stocks, and that's all very exciting, and that drives return. But we're the ones that putting the package together, make sure that we're able to harness those returns while still managing the overall risk for the portfolios. And one of the ways that you manage risk, at least historically, is you have some bonds with your stocks, and bonds hedge stocks when you have equity drawdowns, and that's fine. In an inflationary world, as we talked about earlier, bonds are not going to protect you, right? So you need other things to protect you. One of those things is commodities. And if you think about it, if you're worried about an inflationary shock, you kind of want the thing that's part of the inflation, right? Exactly. And that's commodities. So we've allocated there as well.
Where the beneficial piece is being played out. So let's talk a little bit about equities broadly. But I sort of want you to talk about EM. This is what I want to ask about around the world, because there are commodity producers around the world, of course. There are EM markets that have those, or Canadian companies that have lots of holdings around the world. But what about sort of the discussion of this fracturing, a more multipolar world? There's lots of different things. There's an AI layer on top of everything. How do markets around the world look from an equity perspective?
So the AI thing is key.
Okay.
Right. And so we'll get to EM in a moment,
Sure.
but let's talk about AI.
Sure.
So there's a lot of conversation, there's a lot of speculation. Some of it is very long-term, and you have the kind of utopia, dystopia thing going on. People thinking that AI is going to be the greatest thing ever and usher us into a golden age of productivity and growth and all that. There are people that think that AI is going to take everyone's job and we're going to all end up on, universal basic income with nothing to do, and that's a pretty lousy world because the economy collapses because all of the customers now have no money to buy anything, right?
How do you invest that divergence?
Yeah,
do you?
We're not trying to, in the sense that we don't know what the answer is. It's probably somewhere in between. Nobody else knows the answer either. So we're trying not to make a call on that. What we've decided to do, and again, we've talked about it on the program here, is to rely more on our bottom-up pillar. Right. So basically, we work very closely with all of our underlying equity and fixed income fund managers, their analysts, et cetera. They know the companies involved better than anyone else, better than we would in our role. So they have kept saying consistently to us in recent years that the market is underestimating the earnings power of these companies. Okay. So long as they keep telling us this, we're going to keep being there in terms of the AI theme and associated equity investments. When that changes, we will change. But right now, we want to rely on our own experts that have been right in saying earnings are growing fast and they're growing faster than the market thinks. If earnings keep growing faster than the market thinks, the market is not sustainably going down.
Right. Okay. Amazing. From there, let's take that to sort of, how does this impact the rest of the world? That in theory, you could have big companies in all parts of the world have almost a leveling out of their costs because AI can be implemented. This is the exact story. Deflationary. How do you lean into that story one way or the other?
So you mentioned EM earlier, and this is the right place to talk about that. So people I think generally of the AI story being a US story, and it certainly is, and we know how top-heavy the market is, and the hyperscalers are obviously a big part of that, et cetera. But AI is arguably even more of an EM story than it is a US story.
Wait.
And it's but it's actually in a different way, certainly from an investment point of view. Okay. Right? So, for example, in the US, you have a lot of demanders of AI, the Microsofts, the Googles, et cetera, that are building data centers and investing a lot.
That demand,
and so they're demanding the stuff that allows you to do AI. A lot of the makers in emerging markets, particularly in Asia, and I'm thinking Taiwan, Korea, are the makers of that stuff that enables AI, right? So that's Taiwan Semi, Hynix, Samsung, et cetera. And we don't know what the returns to all of the AI CapEx data centers, et cetera, they're going in. But we do know that if there's more demand than supply for the stuff that goes into it, that's going to be really good for the companies that make that stuff. And a lot of those are in EM. And it's one of the reasons why emerging market equity performance this year has actually doubled what you've been able to get in Canada, the US, or EFI. EM is up almost 20% year to date in Canadian dollar, actually in US dollar terms as well. We've had a pretty significant overweight to EM for quite some time.
All last year the story was international. It's been interrupted from the war this year, but there's lots of different views on that. But you've had exposure for through that international trade last year, essentially.
Yeah, but EFI, so Europe, Japan, effectively, and EM are really different.
They sure are.
Right? So EFI is kind of old school, value oriented, not unlike Canada in terms of sector composition. EM actually looks a lot like the US in terms of a lot of tech exposure, a lot of AI exposure. And as I mentioned, in terms of the suppliers of stuff for AI, it's a different type of exposure than you get in the US. So we're making sure that we have the exposure in both places and managers in both places that can hopefully pick the winners there. Because if you're trying to play AI and you're just invested in the US, you're missing a lot.
And just, I'm guessing the valuation story, even though there's been a large run up in EM stocks over the course of the last year and a half, is still pretty good.
So the valuation story, the aggregates, yes, EM is cheaper than the US. But the interesting thing is valuations in EM in a lot of these big companies have actually been going down. And the reason for that is earnings have been so strong that people are saying, basically they're skeptical of how long that can keep up, and that's a reasonable thing to do. But it means that the outperformance in EM hasn't made that market outright or relative more expensive, right? So we absolutely want to be there. And actually we have now the opportunity to diversify a little bit with respect to our EM managers. So we have a lot of US managers. In the managed portfolios in particular, we have Sam Poliak, who's a fantastic manager, has added a lot of value. There was launch earlier this week,
Yes, we heard.
John Dance, who I think, is he coming
We'll
on
be speaking
to talk
on
to you
this
soon?
program in the next couple of weeks. Yeah.
Yeah, so John is fantastic. He's run money for us in the US for quite some time. Seasoned emerging markets guy. He actually has a somewhat different style from Sam. So
Sam's more Garf.
yeah, I mean, we can't talk about
Okay, we can't.
our activities with respect to new capabilities for disclosure reasons. But John is very good in somewhat diversifying. So he's definitely someone in his capability that's of interest to folks like us. And plus, I'm really envious of his hair. So you'll see that. You'll all see that on the show. But
We'll put you next to each other. Okay, have that discussion. That's funny. Just to kind of sum up for investors, the call is that the world is more inflationary because it's multipolar. It's not something new that you brought to us, but the investment expressions that you're making over the course of the last while are really interesting, and they are new. They're Canada, they're commodities, they're different to what they were. They're less on the debt side, specifically in the US.
Maybe I'll just summarize it in 2 ways.
Please do. We've got a few minutes. I'd like you to give them the takeaway.
On the equity side of the ledger, it really is about AI, right?
Yes.
And equities don't seem to really care that much about Iran, and that's fine. The really big picture stuff on AI is kind of imponderable. So our take is we are going to rely on our equity managers and analysts to tell us what earnings are going to be doing, and we're going to invest on that basis. Right now, the story is still pretty positive, so we're overweight equities. The Iran inflationary shock, multipolar stuff has more to do with the 40 than the 60, which is to say it has more to do with how we're playing defense and diversifying in the funds than offense with equities. And it means less US dollar, much less US bond, less bonds generally, and more diversification into other areas of the world, and particularly commodities, not only gold, but other commodities as well.
Okay. Fascinating changes. What do you want investors to sort of take away from this moment in markets? Because I think everyone's traversing some pretty new horizons, it feels like. I mean, it's probably the story is stick with the steady hand, but is there something you'd like to add to that?
Let me do we have time for a little story?
We do.
Okay, so as you know, I used to be at the Bank of Canada as advisor to Governor Carney. And one of the things we used to do is before an interest rate decision, all of the senior advisors and governing council, including Mark, would sit around and we would talk about our views. One of the other advisors, who shall remain nameless, would always say, there's so much higher uncertainty than there usually is.
Does he work here?
No comment.
Okay.
So there's so much higher uncertainty than there usually is. So we should wait for more information before we make a decision. And my head would explode. And the reason my head would explode is there can't always be more uncertainty than usual. By definition, there's sometimes more than usual and less than usual. And I think the reason that it always feels more uncertain is because we know how things worked out going backwards, which means that we forget how uncertain we felt at the time. And I think this kind of environment is pretty similar, which is, there are a ton of uncertainties. And it's kind of scary, but we think we have an understanding of the underlying dynamics involved. And we can't predict Iran and we can't exactly predict AI, but we can have an understanding of the risks that are associated with those. And so far, we seem to be doing a pretty good job of navigating those risks.
Fantastic. That's a great story. And it's a great way to leave it all. A little bit of hindsight is comforting, I guess, on some level. When we're looking back, we forget how hard it was.
You know what? Remember March, April, May of 2020 and the pandemic, right?
Yes.
Didn't know the world would exist.
That's
now we look back and that was a great buying opportunity.
Yeah.
Well, people didn't, so we fool ourselves. But in my job, you have to try to be a lot more objective than that. And so
it's comforting.
That's what we try to do.
David Wolf, a complete pleasure to speak with you and have us join this audience. Thank you very much.
Thank you.
Thanks for watching or listening to the FidelityConnects podcast. Now, if you haven't done so already, please subscribe to FidelityConnects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. Well, on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or security cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.